Inflation, the sneaky thief that steals your purchasing power. But what exactly is inflation, and why does it matter so much in our daily lives? Let's dive deeper into this economic phenomenon. Inflation is when the prices of goods and services go up over time. This means that the money you have today won't buy as much tomorrow. It's a gradual process, but its effects can be felt by everyone, from the average consumer to large corporations. Think about it like this. Last year you could buy a candy bar for $1. This year, that same candy bar costs you $1.10. That's inflation in action. Over time, these small increases add up, affecting your overall cost of living. So, why does this happen? There are a few reasons. One big factor is demand pull inflation. Imagine everyone suddenly wants to buy the latest smartphone. The high demand can push prices up because there aren't enough smartphones for everyone. More dollars chasing fewer goods means higher prices. Another reason is cost push inflation. This happens when the cost to produce goods goes up, like when oil prices rise. Companies often pass these higher costs on to consumers, meaning you end up paying more. Central banks like the Federal Reserve in the US try to keep inflation in check. They do this by adjusting interest rates. Higher rates can cool off spending and borrowing, while lower rates can boost it. This delicate balance is crucial for maintaining economic stability. But a little inflation isn't all bad. It can signal a growing economy. When people are spending and businesses are thriving, a moderate level of inflation is a natural byproduct. However, too much inflation or hyperinflation can wreak havoc, making money lose its value rapidly. So the next time you notice prices creeping up, remember, it's not just your imagination, it's the invisible hand of inflation at work. And now, you've got the fundamentals to understand it. Keep learning and stay curious. Let's delve a bit deeper into the types of inflation. Besides demand pull and cost push inflation, there's also built-in inflation. This type occurs when workers demand higher wages to keep up with rising living costs. Employers in turn raise prices to cover these higher wages, creating a cycle of rising costs and wages. Another important concept is the inflation rate, which measures how fast prices are rising. It's usually expressed as an annual percentage. For example, if the inflation rate is 2%, it means that on average prices are 2% higher than they were a year ago. Central banks often target a specific inflation rate to maintain economic stability. Now you might wonder, how is inflation measured? Economists use various indices like the Consumer Price Index, CPI, and the Producer Price Index, PPI. The CPI tracks the average change in prices paid by consumers for a basket of goods and services, while the PPI measures the average change in selling prices received by domestic producers for their output. These indices provide valuable insights into the economy's health and help policymakers make informed decisions. For instance, if the CPI shows a significant increase, it might prompt the central bank to raise interest rates to curb inflation. Inflation doesn't affect everyone equally. Those on fixed incomes, like retirees, can find it particularly challenging as their purchasing power diminishes. On the other hand, borrowers might benefit from inflation if they repay loans with money that's worth less than when they borrowed it. Businesses also feel the impact of inflation. Rising costs can squeeze profit margins, leading to higher prices for consumers. However, companies with strong pricing power can pass these costs on to customers more easily, maintaining their profitability. Governments play a crucial role in managing inflation. Fiscal policies, such as adjusting tax rates and government spending, can influence economic activity and inflation. For example, reducing taxes can increase disposable income, boosting demand, and potentially leading to higher inflation. On the flip side, increasing taxes can reduce disposable income, curbing demand, and helping to control inflation. It's a delicate balancing act that requires careful consideration of various economic factors. International factors can also influence inflation. Global supply chain disruptions, changes in commodity prices, and exchange rate fluctuations can all impact domestic inflation. For instance, a rise in global oil prices can lead to higher transportation and production costs, contributing to inflation. Understanding inflation is crucial for making informed financial decisions. Whether you're saving for retirement, investing in the stock market, or simply budgeting for your household, being aware of inflation's impact can help you plan more effectively. For instance, when planning for retirement, it's essential to consider how inflation will affect your savings. Investing in assets that historically outpace inflation, like stocks or real estate, can help protect your purchasing power over the long term. In conclusion, inflation is a complex but vital aspect of macroeconomics. It affects everyone from consumers to businesses to governments. By understanding its causes, effects, and how it's managed, you can make more informed decisions and better navigate the economic landscape. So the next time you notice prices creeping up, remember, it's not just your imagination, it's the invisible hand of inflation at work. And now, you've got the fundamentals to understand it. Keep learning and stay curious. Central banks, like the Federal Reserve in the US, try to keep inflation in check. They do this by adjusting interest rates. Higher rates can cool off spending and borrowing, while lower rates can boost it. This delicate balance is crucial for maintaining economic stability. They do this by adjusting interest rates. Higher rates can cool off spending and borrowing, while lower rates can boost it. This delicate balance is crucial for maintaining economic stability. Higher rates can cool off spending and borrowing, while lower rates can boost it. But a little inflation isn't all bad. It can signal a growing economy. However, too much inflation, or hyperinflation, can wreak havoc, making money lose its value rapidly. So, the next time you notice prices creeping up, remember, it's not just your imagination. It's the invisible hand of inflation at work. And now, you've got the fundamentals to understand it. Keep learning, and stay curious.